Today students, today we are going to study about, our course is about business finance. So let's start. I have here a audio video presentation so that you can study very well, meaning to say the purpose of this audio video presentation is to capture the four types of learners. Number one, if you are a auditory learner, meaning to say you have a good listening skill. So with this AVP, you can listen, and since your strength is your listening skill, you can listen and understand this lesson. The second learner is visual learners. So with this AVP integrated with my audio, you can watch while you are learning. The third type is reading and writing, meaning to say you watch and listen, you read and write. So the strength of students while watching and listening, they tend to write and they tend to read. The fourth type of learner is kinesthetic, meaning to say these are students who are doing an activity while learning. They are multitasking. So the purpose and intention of this audio video presentation is to capture the four types of learners so that I can provide quality education and at the same time return the investment of your parents and guardians. So to start with, let's have first a definition of terms, no? Definition of terms. Let us try to define what is business finance. Business finance means the funds and credit employed in the business. So funds and credit. Okay, this is letter F. Okay, that is letter F. Finance is the foundation of a business. So business finance is the foundation of the business. Finance requirements are to purchase what? Assets, goods, raw materials for the other flow of economic activities. According to B.O. Wheeler, business finance includes those business activities that are concerned with the acquisition, no, and conservation of capital funds. This one. Okay. In meeting the financial needs and overall objectives of a business enterprise. So you need to acquire and conserve a budget, no? The capital funds so that you can meet the financial needs and overall objectives of the enterprise. Business, okay? Business is identified with the generation and circulation of products and services for fulfilling the needs of society. For successfully doing any operation, business requires money, which is known as business finance. So, business finance is a form of money in order for the business to do its activities. Therefore, funds are known as the lifeblood of any business. Of course, without the funds, you cannot operate the business. A business would not function unless there is adequate money accessible for use. The capital contributed by the businessman or the investment shell out by the businessman to establish the business isn't adequate to meet the financial needs of the business. Consequently, the businessman needs to search for an option to generate funds. A research of the financial need and options to fulfill those needs must be done with a specific end goal to arrive at effective financial management to maintain the business. There are fundamental necessities of business. Would buy to, let's say, a company or a factory or any equipment, or you could buy raw materials. Development of a business that prompts more enrollments, paying wages, and so on. The money-related necessities of business can be classified as follows. So we will now go to the definition of accounting. Okay. So fixed capital. In order to begin a business, money is required to buy fixed asset. What are examples of fixed asset? Land, building, company, plant, factory, machinery. These are fixed capital assets. And then, number two, working capital. What are the requirements of a working capital? A business needs funds for its day-to-day activities. This is known as working capital, the money that you do day-to-day. Working capital is required for the purchase of raw materials, salaries, payment of salaries or wages, rent, and taxes. And then, we have also diversification. A company needs more funds or need more money to diversify its activities to become a multi-product. Not only a single product, but the company aspires to sell more products. Okay. Another one is technology or upgrading technology. You need finances, money needed to adapt wants to update your latest machineries and equipment. Use of particular example, software and latest computers in business. Okay. All right. What is the importance of business finance? Importance. What is the importance of business finance? Importance. Okay. We know the meaning of business finance. Let us learn its importance or relevance. Business finance is an essential requirement for the establishment of any business. Money is actually the most important tool to bridge the gap between production and sales. Let us take a look at some of the important functions of business finance. Number one. Okay, number one. Okay. So one function, we require business finances to meet certain contingencies and any unexpected problems that may arise. Number two, functions necessary for the promotion of sales. No? Number three, a requirement to avail any business opportunities that may present themselves. So, I have a question. My question is this. Does only large companies or large corporation require business finance? True or false? And explain why. Is it only large companies that needs business finance? Do you agree with that? If you agree, why? If you disagree, no, why? Okay? So, Let's go to the second slide. What are the functions of a financial manager? Of course, if you have a business finance, you must have a financial manager. So there are four functions of a financial manager. We have financing, investing, operating, and dividend policies decisions. So you can see that there is a similarity of a word, and this is decisions. So it is more appropriate, no, that the financial manager conducts a financial decision. And what is this financial decision? Financial decision is a process which is responsible for all the decisions related with liabilities and stockholders' equity of the company, as well as the issuance of bonds. No? Remember, what is the formula for asset? Asset is equal to liabilities plus owner's equity. So the financing or the uh, financial decision, the financial manager is responsible. No, he has to decide that is related to liabilities and owner's equity. So he takes care of the entire asset of the company. Okay. So there are some financial decisions, types of financial decisions in financial management. There is investment decisions, number one. There is also financing decisions, number two. And there is also dividend decisions. So we are going to study the number two, which is investment decisions. A financial decision which is concerned with how the firm's funds or money are invested in different assets, and that is called investment decisions. It is a financial decisions which is concerned how the firm's money are invested in different assets. Investment decision can be long-term or short-term. A long-term investment decision is called capital budgeting decision. Capital budgeting decision, long-term. What is this? Capital budgeting decisions involve large amounts of long-term investments and are irreversible except at huge cost. The next is short-term investment decisions, which are called working capital decisions. This affects the day-to-day working of a business as we defined it previously. It includes the decisions about the level of cash or cash flow, the levels of your inventory, and your accounts receivables. So in other words, a bad capital budgeting decision normally has the capacity to severely damage the financial fortune of a business. And also, a bad working capital decision affects the liquidity and profitability of a business. The liquidity is the cash flow of your company. Let's go to um, some additional inputs regarding financial decision. Uh, that financing decision is concerned with the amount of finance to be raised, amount of money to be raised from various long-term sources of funds like equity shares, preference shares, debentures, bank loans, etc. Those are kind of financing decisions. In other words, it is a decision on capital structure of the company. So you talk about the capital structure of the company. By the way, there are factors affecting financing decision. Number one, cost. The cost of raising funds from different sources is different. The cost of equity is more than the cost of debts. The cheapest source should be selected prudently. Number two, we are talking factors affecting financing decisions. Number two, the risk associated with different sources is different. More risk is associated with borrowed funds as compared to owner's fund, as interest is paid on it and it is also repaid after a fixed period of time or on expiry of this tenure. Number three is flotation cost. What is this? The cost involved in issuing securities such as broker's commission, underwriter's fees, expenses on prospectus, etc. is called flotation cost. Higher the flotation cost, less attractive is the source of finance. Number four, cash flow position of the business. In case the cash flow position of a company is good enough, then it can easily use borrowed funds. Okay, let us go to dividend policies decision. What is this? What is dividend policies decisions? Okay. A financial decision which is concerned with deciding how much of the profit earned by the company should be distributed among shareholders or the owner of the company. Dividend, no? How much should be retained for the future contingencies or what we call retained earnings. And that is dividend decision. Dividend refers to the part of the profit which is distributed to the shareholders. These are the owners of the company or the board of directors. The decision regarding dividends should be taken keeping the view the overall objective of maximizing shareholders' wealth. There are also factors affecting dividend policies decision. Number one is the earning of the company. Number two is stability of dividends. Number three, growth prospects. And number four, cash flow positions. Number five, preference of shareholders. And number six is taxation policy. So there are many factors. And all of this decision has to be studied by the financial manager. So let's move to the next slide. So one by one, we are going to discuss about financing decisions. So we have a situation, lack of funds or lack of money, and determination of capital structures. So when we talk about lack of funds, the financing decisions, how to fund long term. So long term, that is capital budgeting, and short term investment. Example of capital budgeting, long term, company expansion, or there is what you called, you move out, you transferred the location of your factory. That is another example of long term. Another example of short term is payment of operating expenses and purchase of raw materials or inventory. Okay, those are examples of situations regarding lack of funds. Capital structure, no? Number two, capital structure. How much total asset is financed by debt and equity? So you remember the formula: asset equals liability plus owner's equity. So you are talking on the capital structure, how much total asset, this one, is financed, by liability and owner's equity. That is what is mean. If we acquire assets by cash, it came from equity. Dito, by cash. If we acquire assets by borrowing, it came from debt. Dito. Okay? So that is the capital structure. For example, you borrow in the bank. No? So that is in the form of loan. So you are going to pay that mortgage. So that's a liability. Okay. Investment decisions. Let's go to investment decisions. So again, we have two types, short and long term. No? So you can see here that in the short term, company has excess cash position. Okay? And what is the tool for short-term investment? That is budgeting and forecasting. No? And the decision, choose an investment with less risk but high return. So that's the choice of the financial manager. While in the long term, he must use different tools for capital budgeting analysis. The tools for capital budgeting is net present value, cost benefit analysis, internal rate of return, and return of investment. Okay? So these are the tools needed by the financial manager to analyze long-term decision making or investment. Let's go to operating decisions. The criteria here is risk and return trade-off. What is this return? Return of investment or return of investment. Okay. All right. What are examples of daily operations of the company? Number one is daily operations of the company. How to finance working capital. The working capital, you already know this. This is the money that you use for the day-to-day activities. So how to finance working capital accounts? Example, accounts receivables. What are accounts receivables? Account receivables are the money that the company is going to receive as payment from a product or service that was acquired by the customer. Okay? For example, there is a customer that buys product at let's say 5,000 pesos, so payable in 15 days. That 5,000 pesos that the customer is going to pay after 15 days is called accounts receivables. So inventories could be your number of items, finished product inside your warehouse. No? So these are called inventories. Number 2 bullet, financing working capital can be short or long-term sources. Short-term loan payable in 12 months from banks and suppliers. Risk, it poses liquidity risk. Company may not able to obtain cash in a short period of time. Trade-off is equal to profitability and liquidity risk. No? Of course, your profitability, meaning to say you have revenues or sales, and then you have expenses. If your sales is very low and your expenses is very high, you have negative profit. But if your revenues is equal to expenses, it is called break even. No loss, no sale. So number 2 is last bullet is interest for short terms in banks are lower as compared to long term, of course, no? Okay? So that is the trade-off. So when we are talking about decisions that may arise about operation, the financial manager is considering risk and return trade-off. And this is profitability and liquidity risk. Okay? Next. So we go to the dividend policies decision. As I discussed a while ago, this pertains to the dividend that is going to be returned to the shareholders. No, the financial manager should inform the investors or shareholders when dividends are expected. Dividends, these investors buy a share or stocks and expect to receive dividends from the investment. That is their profit from their investment. Cash dividends are paid to shareholders based on their shareholdings in the company as return of investment. So, two conditions to declare cash dividends by the financial manager. One, company must have cash or company should be liquid. And company must have enough retained earnings or accumulated profits. If these two conditions are not met, of course, the investors will not have a dividend. Okay? So, we have private placement. What is this? When we say private placement, it is the sale of new security directly to the investor or group of investors or shareholders. Financial market, organized forums in which the suppliers and users of various type of funds can make transactions directly. Financial institutions are intermediaries that channel the savings of individuals, businesses, and government into loans. For example, intermediaries. Example are banks. Central bank are example of intermediaries. Financial instrument is real or virtual document representing a legal agreement involving sort of monetary value. This can be debt securities like corporate bonds or equity shares of stocks. Okay, so let's try to study debt instruments. Debt instruments generally have returns due to fixed interest rate. Example of debt instrument: treasury bonds or treasury bills. This is issued by the Philippine government. The characteristic of treasury bond, it has low interest rate and low risk of default since it assures that this will be paid. The next is corporate bonds. Corporate bond is issued publicly by listed corporations. Example, ABS-CBN, Meralco, PLDT. Corporate bonds have high interest rate and risk in terms of bankruptcy. The holder of bonds will not be paid with interest and principal. So that is in terms of bankruptcy, the criteria if you are a holder of corporate bonds, you will not be paid of the interest and principal. Let's go to equity instrument. What are examples of equity instrument? Preferred stocks, common stocks. There is a difference between those two. If you say preferred stocks, it means the priority dividends that common stocks but with a fixed dividend rate. What does it mean? It means to say that there is preference, no? The priority dividends than common dividends, no? Because a common stocks, these are real owners of company. If business is profitable, common stockholders will benefit growth in terms of the dividends policy decisions. We have classification of financial market. When we say primary market, this is to raise money. User of funds will go to a primary market to issue new securities, either debt or equity, through a public offering or a private placement. When we say secondary market, these are supplier of funds or holders of securities sell the securities that have previously been purchased. The sale of previously owned securities takes place in secondary market. So this is primary secondary exchange, no? Okay. What is money market and what is capital market? Money market is a venue or a place wherein securities with short-term maturities, example 1 year or less, are sold. That is money market. While capital market, these are securities with longer term maturities are sold. Securities with longer term are example bonds and common or preferred stocks are examples. Equity or ownership are examples of a venue for capital market.